Good morning, traders. It's Thursday, the 10th of March, 2016. It's 8 a.m. Chicago time. This is Rollover Thursday. I'll talk about that for a little bit. But let's start off with our usual risk disclaimer. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not indicative of future results. The news overnight clearly dominated by the ECB announcement. The European Central Bank cuts its main refi rate 5 basis points to 0%, lowered its deposit facility rate 10 basis points, which is a lot, to negative 0.4%. It also said that it would expand its quantitative easing program to 80 billion euros per month from 60 billion euros. Big news. The euro was down to $1.08 at a point $1.0822 on the futures. The yen is down, crude oil is down, the 10-year treasury is slightly down, gold is slightly down, the bonds are slightly up, the European Bund is slightly up, and the S&P is up 0.62% or 12 points, and the DAX is way up with the Euro stocks dominating. The Euro stocks up 71 points and 2.35% in Europe. Clearly, the sentiment is moving towards risk assets. The Asian market, the Nikkei, finished up 1.26%, the Shanghai down 2%, and the HSI flat yet again. The HSI been flat for 3 sessions straight. In other news, the New Zealand bank also surprised by reducing rates last night. And overnight, China showed that its inflation is picking up slightly, which is a good thing for them. So those are the key elements. Looking ahead at today, and remember, Draghi is still speaking right now. So if you're in the Bund, the Euro, European products, you're likely to be affected. But other than that, looking at today's calendar, overall, we're looking at EIA natural gas at 9:30 Central, 10:30 Eastern, and at 11 Central, 12 Eastern, we have this number which I haven't seen before: U.S. household net worth for the fourth quarter, and then of course the 1 o'clock Central, 2 o'clock Eastern monthly budget statement expecting negative 196.5. A lot of spending there, and then and that's really it. Just a half hour ago, we also got the initial claims release came in at 259,000 versus 275,000. This is a much stronger number here. It's less than expected, showing fewer claims. Fewer claimants. Continuing claims 2.22 million versus 2.25 million. By the way, the initial claims this week is the lowest since last October. Again, that came out just before the press conference with Draghi. Let's switch gears now and look at the technical picture. I'm going to take you back a little bit to a trader bite I did. You can see here the date on the 3rd. These should be in HD, but since the video is not playing, it doesn't show up in HD, so it's slightly fuzzy. But it's viewable still. You can see here that on this day, the 3rd of March, this was a week ago, exactly last Wednesday, given the big rally up, the expectation that I'd set out, and on a longer term basis, we're talking about what the longer term reaction is likely to be, and I talked about it pushing back down right here as I drew it, pushing back down into the 1970, 1965 area, and then likely turning up towards 1990 and through to 2000. And over the next couple of sessions, I talked about the 2000 2014.50 or 2013.50 being a key figure above. That is on the March contract, by the way. And before we get into the technicals too much, it's going to be a little bit confusing today because today is the official rollover day for U.S. equities. My charts have rolled. The exchange is has put in that has moved to the June contract as the front contract, and so what you're seeing here are charts that look like they're off. Like here, you see that we're trading 1992.25 when the March contract, the one we were trading just yesterday, is at 2001 and a quarter. The difference between the contracts is negative 9.25 points. So that's the adjustment. That's the premium. So my charts take that into account, and they adjust all of the contracts going back as far as whatever 25 years or whatever. They adjust for those 9 points to make the product continuous. But if you look at what I'm doing today, it's going to be all June contracts. So this may be confusing for you if you're planning to trade where the volume is, which is still in the March contract, and this is very typical. And a lot of people decide to stay with the March or move to the June. It doesn't make a difference to me personally. I prefer to just roll to the front month and start quoting it, since my charts actually force that issue. But also, I just like to do things with the exchange. The liquidity is plenty enough for me to trade off of. It doesn't really make a difference. And as the day goes on, you'll find that there's an acceleration in the volume coming into June versus the volume coming into March. But in either case, folks have to move their holdings from March to June. So that's how the futures world works. So when I show you this, which is yesterday's plan, it'll have March's contract on it. And yesterday's plan, the primary hypothesis is we did transition down, and we are I talked about yesterday, hypo 1 being that we would open, we would probably rotate down to the naked point of control. As you see here, there's the naked point of control, and we were likely to do this back and forth. I drew this yesterday on yesterday's chart, back and forth, back and forth, back and forth, back and forth, and I said that it's likely to be a slightly aggressive session in that both sides have an incentive to interact, where the market has a magnet above it at 1991, which is the MC point of control, and it has the point of control from yesterday below, and it's sitting in a fairly balanced composite, as you can see, and that the result of that is turbulence, especially coming into an announcement like the ECB today, and rollover and expiration. Anyway, I went over that. If you want, you can always go to my YouTube channel and watch the video from yesterday. Just push forward to about 12 minutes in, and it'll go over why that expectation was there. Let's take a look at what happened. And there it is, folks. The market opened, and it just moved down to the point of control and back and forth, back and forth, back and forth, completely balanced. It's an odd-looking balance profile. It has almost a double distribution in it, but the market did not breach the range very much, and it definitely didn't breach the high or the low of the prior day. It just sat inside, and it just traded sideways. It was completely balanced yesterday. The market was coiling. Overall, the volume yesterday was in line, except for the afternoon. The volume in the afternoon was pretty poor, even though this is reflected in the June contract. The March contract looks the same. The 20-day average volume was way up here, and the actual volume for the last bar was way lower, almost 50%. There was just no participation coming into the product into the close, and most of the session the volume fell off pretty hard, as opposed to falling off and coming back up as it normally does. So overall, yesterday was a completely balanced day. What do we have when we have balance inside of balance? The guess is imbalance. The next thing that would take place is most likely to be an imbalance or a trending type day or a breakout. We love balance days for that reason. They're terrible to trade. If you're a swing trader or a long-term trader, they're great. If you're a day trader scalper and can recognize them early on, we have various tools for recognizing them. If you want more information on that, you can watch the videos on my website, futurestrader71.com. There's an archive of tons of free videos. If you want the succinct version, there's a webinar series that you can contribute to. So, where are we? We are still stuck in this zone here that I boxed out a couple days ago. We keep probing higher and falling back off like we did here. But the overall target in the June contract is 2005 now. It used to be 2014 and a quarter. 2014 and a quarter in the March contract, 2005 in the June contract. So the overnight session on the March and on the June contract got to 2001. 2001, so that would be what, 2010 and a quarter, 2010 or so in the March contract. So we were within 5 points of getting this extremely important area here at 2014 quarter and in the March, 2005 in the June. And so overall, we've done what was expected. We've pushed higher. We've had a one-time framing for a while. Then we had an inside day right here, and then we've balanced lower. We've pushed lower day before yesterday, and then yesterday we had another inside day. The market is basically trying to push lower to advertise for lower prices, but it's being kept in check. We keep trading inside of these days, so we're looking for balance and breakout, balance breakout as we usually do, the auction is pretty. In my opinion, the option is pretty methodical. So this morning, we are up here in the June contract. We are up against the naked point of control from the 7th, from last week, and we are in this area here. You could see that we are stuck in this area here. We're opening up against this. We have 2 days of balance beneath us. We have balance above us. Again, we are in the noise. The expectation this morning is a return to the scene of the crime. The scene of the crime is lower on the ECB announcement. I'm expecting it to be a choppy open auction out of range is the expected opening type, and I'm expecting it to break lower, looking for 83 and a quarter, and then looking for the 2-day balance. So what we need to do is draw a profile over these 2 days to see where the balance is. There's your 2-day balance. The balance is down here at 75 and a quarter. But value high is at 1980, and that's the expected area to push to. I'm expecting it to chop, move down into that 1980 area, and then start to rotate up and move towards the 2000 again. That's what's expected. We've explored the lower side, and the market has rejected it so far. So you can see these rejections here, there, and there. And the market keeps basing and building double tops at the high and continuously putting in weaker highs. Yesterday's high was fairly decent, was fairly normal, but overall the expectation is for it to drop back into the 1980, chop around, and then find its buyers, and then start to move back up into the upper range of Monday's trade. The overall trend is expected to continue higher. Again, 2005 being the key figure above. That's a lot to cover in a short period of time, but my time is up. Hopefully you're gaining something from this. Remember, your goal is to come in every day and work on a skill set or an issue that will improve your trading. Do not come in and just watch the market and chit chat and whatnot. You'll find that as time goes by, you're developing habits that don't serve you. So on a daily basis, your goal is to focus on executing your plan as as clearly and as cleanly as possible. That's the task at hand, whether you're on the simulator or live. You want to be always connected to the journey rather than the result, because all of us can, put on 100 lots in the simulator and pretend like we could be millionaires by the end of the month. But the fact is that doesn't get you anywhere. It's just a waste of time. So on a daily basis, you should be tracking your performance and setting out on a daily basis with a commitment of improving some aspect of your trading. That's called deliberate practice. And if you do that long enough, in my opinion, you are likely to gain skills that not only serve you in trading, but serve you in life in general and professionally. So even if you decide to stop trading and move on to some other endeavor, you've picked up some habits that are going to serve you for life. This is what's great about trading. Thanks for listening in. I'll catch you tomorrow. Take care.